Hello, everyone. David from Mortgage Choice. It is Tuesday, the 1st of August, and the Reserve Bank announced this afternoon that they're keeping rates on hold. So no increase. It's the second month in a row where we've not had an increase, which is fantastic news for all of you holding a mortgage that have been calling and ringing and sharing concerns about, what would happen if rates continue to go up. Hopefully, this is a sign that the Reserve Bank has reached the top of the cycle and that hopefully we see rates plateau and remain the same for the next 6 to 12 months before we see them coming down. That seems to be the expectation within the market right now, that we may still potentially see one more rate rise, but there's not much more to go after that. And then we'll see a bit of a waiting period as they determine how much of an impact these rate rises have had on the economy. And it's starting to, from the words that the Reserve Bank had today, these rate rises are starting to impact the economy. Spending was certainly down last quarter, and last month, year on year, it was down quite a bit. So they're starting to see the signs that they were hoping for, that the economy is softening a bit, and hopefully that means that inflation will come down a little bit faster. The downside, obviously, with all these rate rises is that we've had more and more clients calling up with concerns about making repayments and getting by. And a sign that arrears on mortgages just have started to increase, not to an alarming rate, but certainly more than they were 6 months ago, even 3 months ago. And this will likely be an ongoing issue as clients coming off of record low fixed rates and onto variable rates that are sitting at around the 6% mark. And it just further supports the need to give us a call and work through your situation. If you are coming off a fixed rate or if you are having issues, then give us a call and we'll talk through how we might be able to assist. On the other side, as far as improvements and what we're seeing there, certainly things feel like they're starting to change for the better. We're starting to see more and more purchasers coming into the market. This last month, in June, we saw 35% of all lending going to investors, which is the biggest percentage of lending to investors since 2017, when we had a massive boom in investment lending. So it's a sign, if we can see investors starting to come back into the market, then that usually means that we've reached the bottom of a potential property cycle and even a rate increase cycle. And that it's likely that values will start to increase. And any property report that I've seen over the last couple of weeks has spoken about property values increasing. It's small increases, 2-3% across Melbourne, but certainly property values seem to be ticking up. And it's no surprise, we've spoken about it for months, that you've got a massive amount of people coming into the country. The government's trying to encourage a big population growth, and people need a place to live. So it's no surprise that if we don't have a lot of supply, if we've got a low supply of buildings coming onto the market, and we've got a ton of people needing to live somewhere, that we're going to have increased demand for very little supply. Values will go up. So I wouldn't be surprised to see the market take off over the next 3 to 6 months. And we're coming into an interesting period of time now. Normally, seasonally, we start to see a massive increase in spring. So we're about a month away from seeing what usually is the biggest point of the year where we see properties on the market and properties selling. So time will tell. But along with investors, we've certainly seen an increase in first home buyers. The one area that we haven't seen a big increase for is upgraders. Clients that are going from that house in that 700,000 to 800,000 range and wanting to purchase up in the 1 to 1.2 million range. So I would imagine that in the next 6 to 12 months that will improve. But people are just kind of waiting to see what happens with the market before they make any major decisions, which makes sense. We do have a webinar coming up, which I'll talk about at the end of the video today, for upgraders. If clients are looking to upgrade their home, there's a lot to it. If you're going from one house to another, we need to talk about a number of things, not just borrowing capacity, but also how do we physically relocate you from one house to the next. So I'll share the details on the webinar coming up. As far as other things that we've seen on an improvement point of view, banks are certainly changing their policies. I think banks have not written near as much volume as they would like. And so they're starting to make changes that will help them write more business. And it's also adding benefit to clients. So one of the biggest things that they've done is change their assessment rate. Normally, when banks look at your borrowing capacity, they will take the current rate at say 6%, and they'll add on a 3% buffer. And they'll service your loan at 9% to ensure that you can afford interest or afford mortgage payments when interest rates do go up. And they've changed their policies recently that if you're refinancing dollar for dollar, so if we don't need to increase your mortgage, we're just leaving it exactly as it is now. As long as we can get you a lower payment with the new bank, then they'll assess you at 1% instead of at 3% as a buffer, which is a massive, massive benefit for us, because for those clients that over the last 6 months weren't qualifying for a refinance, all of a sudden we can get those clients across the line. So if you're on a mortgage, on an interest rate, and your bank's not being flexible, then we can use these new policies that the banks have, this 1% assessment rate rule, and try and refinance you to a new bank. Obviously, dollar for dollar, so no increase in the mortgage, but hopefully it means a lower interest rate and therefore a lower repayment. And the other benefit too is that we're able to take your mortgage and spread it out over a 30-year period to give you a smaller required repayment. All right, so you still have the ability to pay extra if you want to, but because it's a new 30-year term, you've got a smaller required repayment to make. We talked also too about, we've spoken about the good things, but we also need to touch on a couple of the bad things. Now, the fact that we didn't increase interest rates this month, and that the Federal Reserve in America did increase interest rates, it means that there's a bigger disparity between our rates and the rates in the US. And when we have that disparity, it means that our currency takes a hit. So after today's announcement that we weren't going to increase interest rates, and the fact that last week the US increased their interest rates, now we've got this discrepancy between the two, and our dollar value dropped this afternoon by about 2% on the RBA news. So if you're traveling overseas and looking to convert that Aussie dollar into a US dollar, it's going to be a little bit less in your pocket now than it was earlier this afternoon. And that will likely continue to be the case as America is on a different path, obviously trying to control inflation. They seem to be controlling a little bit faster than we have. So I'm not sure why they increased interest rates last month or last week, but it looks like they'll continue to be quite aggressive, and we might see the currency exchange dropping a little bit lower, certainly not in our favor. I think that's about it. I think that's about all I need to announce. The webinars, we've got the webinar coming up on the 23rd of August, so Wednesday the 23rd, 7:30 start time. We'll send a link or attach a link below so that you can register. And this webinar is for any clients looking to upgrade in the next 6 to 12 months. And we'll talk about how you can release equity in your existing home to cover the initial deposit that you need. We'll talk about your borrowing capacity. We'll talk about the purchase price that you're after. And we'll talk most importantly about how we physically relocate you from one house to the next, and how we get that timing right? Do you sell first and then purchase, or do you purchase first and then sell? Can you qualify for bridging finance? So plenty of things to cover. It was one of our most popular webinars that we did last year. So we're excited to bring that back and hopefully help a lot of you clients that will be looking to make some changes in the next couple of months. As always, thanks for your support. We'll continue to do reviews for all of our clients. If you know of anyone else that might benefit from a review, if you know of a mom or a dad or sister or brother or a work colleague, anyone that hasn't reviewed their mortgage in the last 2 or 3 months, please get them to give us a call. Oftentimes, we're keeping them with the same bank that they're already with, but still able to renegotiate a better rate. So if anyone that you know needs some assistance, please pass them our way. Thanks again for your time, and we'll be back to you next month.